Every up market comes with a down market. Every bear market comes with the bull market. In today's video, we're going to talk about how sometimes overconfidence might have an impact on your portfolio at the wrong time. Hi everyone, it's Logan Sadler. Thanks for stopping by the Financial Beat YouTube channel, and thank you for taking the time to watch this video. As usual, we're going to go over some topics that might be very interesting to you. This video is actually on overconfidence. As you guys know, I am a financial advisor, and I'm lucky enough to meet with lots of different people and have met with lots of different people throughout the years. And one thing I have found is there is some people out there that might go by rules of thumb, or might go by some of the different things they've read. And then there's some people that are just extremely overconfident in their portfolio, or maybe their ability to manage their portfolio. And it becomes very dangerous at certain times if you don't understand the impact of your portfolio and the overconfident measures that you're taking and what those impacts can be over a 5, 10, or 20-year retirement. One of the things I like to start with is the market, right? It's one of those things where most of the time when I'm talking about overconfidence, it comes from either real estate or stocks or bonds or the traditional equity markets, where you might become a little overconfident in either your ability to manage it or in the ability of the market. I always like to say the historical average returns of the market are somewhere in that 9 to 10% range, depending on which areas you're looking at, what time frame you're looking at. And that's a pretty historical return and not a bad return. Most people would take that. The one thing I always like to say is when you're developing a strategy, most of the time when I meet with people, they are not 100% invested in the S&P, even though they're kind of trying to factor in how much they're going to draw based off of the S&P. So it's something where you really want to make sure you're comparing apples to apples and looking at the variations of the impact of your portfolio. Classic overconfidence. I have one client who we've met with several times throughout the years. She came on board a little while back, and when she came to us, it was one of those scenarios where, like a lot of you, she's done very well saving for retirement. She put away over $1 million in her 401k and had some other assets. In her 401k, she had $1 million, and she actually had over $400,000 invested in one stock. Happened to be company stock, by the way. And it was funny because she really had thought about the risk, while she was working. But as she got closer and closer to retirement, she said that was just keeping her up at night. All of those years that she had been so overconfident in that individual stock. Those of you watching the video, some of you might not be comfortable having money in one or two stocks, let alone just one. And so we were able to show her the impact of being able to diversify and move things around when it comes to getting ready to gear up for income and all the other stuff that comes for retirement planning. But it was so amazing that one client had over 40% of her portfolio in one stock for the majority of her working career, and it just so happened to work out for her. But it was something, like I had said, when she was getting ready to retire, those last year or 2 years it was in there, it was really eating at her and really made her feel not as confident in her retirement plan because so much was dependent on one individual stock. For those of you watching the video, classic rules of thumb, a lot of advisors or books you read, they don't typically recommend you want more than about 5 to 10%, maybe 15% in some cases in one stock or one security. So as you can see in that example, we were able to really lessen the load and not necessarily give up too much on the return end, but also be able to scale back the risk and the overconfidence that she had in that scenario. The other thing I see a lot with clients when we're planning to prepare for retirement and they come in is classic overconfidence in either their ability to manage the money or their advisor's ability to manage the money. I always like to say the advisor or the manager is only as good as the market, and you want to make sure that you're investing and that your expectations are reasonable. One of my favorite questions to ask to clients right away when they come in and we have a discovery meeting and they're deciding if they would like to come on board with our firm and we're deciding if it's a good fit. Sometimes I'll ask them, what is a realistic expectation of return for you? And you can always tell the clients that know the market and know kind of what to expect from portfolios and returns. And then you can always see those clients that are way overconfident in the ability to perform. Classic example is they say, well, I'm getting ready to retire. I got $1 million. I should be able to take out 100 to 150,000 a year and be just fine since my portfolio's average 10 or 15%. Well, unfortunately, that's not a realistic, by far, not a realistic expectation for income. And one thing I always like to say is the portfolio you're in probably isn't the same portfolio you'll be in retirement. A lot of people do tend to scale back risk. So you have to take the trade-offs with risk versus return. And I've seen so many people where they are looking at income and they've always kind of gotten obsessed with, I need to put away $1 million or I need to put away $500,000. They've always had that goal in mind. And I always like to flip it and make sure we're planning not necessarily for a dollar amount, but for an income amount. How much income do you need to generate in retirement to feel that you've sustained the lifestyle you'll be able to live in retirement, that during your working career and in retirement? And that's really what matters the most. You have all these different rules out there, like the 4% rule. Some of you might have heard of the 4% rule, where you could take 4% per year of your portfolio out, and it's a safe enough amount to where you won't run out of money, okay? I don't always base things off rule of thumb. That's just a classic rule of thumb that's been around a long time. But that is a safe amount for most people, depending on the portfolio, that you could draw out about 4%. I do have clients where we were able to structure their investments and structure their portfolio to where in some cases they could take out more, maybe 5 or 6 or 7%, depending on what type of investments and what type of returns we've been looking at. But the most important thing I always tell people is you want to make sure you're meeting with a financial advisor to make sure that you're setting realistic expectations. Taking too much money out too early in your retirement can be absolutely crucial. And typically it's hard to recover after taking too much money out. The one thing I always say with people is, let's say your stock market, you're 100% invested in the stock market and your account went down 10%, right? We do have times where the market doesn't always perform positive. So if your account went down 10% and you're taking out 18 or 8%, that means that your account that year suffered an 18% investment loss. So it's something where you need to really think about how the impact is going to look on your retirement when you're not adding $10,000 a year to your account. You might be taking $10,000 a year from your account. And you really want to make sure you understand the impact and how that looks over a 5, a 10, a 30-year time frame. Some of you people coming in and meeting with us, you're 55 years old or 60 years old and pulling the plug to retire. So your portfolio needs to last you 25 or 30 years in some cases. So you want to make sure you're not being overconfident and getting too excited too early, and make sure you're setting realistic expectations. At the end of the day, understanding risk, understanding your investment plan, everybody is unique and every investment plan should be customized to you, but making sure that you're setting realistic expectations, again, that are sustainable over your retirement are the most critical components to any good retirement plan. I want to say thank you for stopping by the Financial Beat YouTube channel. I look forward to seeing you guys. As you guys know, we're here every week on this Financial Beat YouTube channel. Head over to our website and catch all the other videos, or click right here on YouTube and click subscribe and catch our next available content. We'll see you guys next week. Thank you.